In psychology, this self-talk is known as verbal reasoning. By converting vague feelings into specific language, the brain is forced to organize information logically. While an amateur feels an opportunity, a professional states it. I am entering because conditions A, B, and C have aligned. If D happens, I exit. I accept risk X. This is just one of 30 trades this month. This transforms trading from an emotional gamble into a structured process. The trader's brain is a delicate instrument. The same data processed in a high-stress state, fueled by cortisol and adrenaline, produces a vastly different decision than when processed in a state of calm. These hormones directly impair your ability to read charts and calculate risk. Self-talk is a tool to slow down the decision-making process, forcing the brain to switch from the emotional system to the rational one. If you talk to yourself, don't be ashamed. It might be the only reason your account hasn't blown up yet. Part 2. Productive overthinking. There is a common myth that a great trader is a person of lightning-fast action who never hesitates. This belief has destroyed more accounts than any poor strategy because the market is designed to exploit impulsiveness. Every sudden candle or newsflash is bait for those who act before they think. Consistently profitable traders actually think more, but their cognitive complexity is different. An amateur sees a simple up or down question. A professional sees a system. If price rises on low liquidity, that means X. If volume drops at this level, the structure is failing. To an outsider, this looks like hesitation. In reality, they are questioning their own signals. While an amateur seeks confirmation, reasons to be right, a professional seeks disconfirmation, reasons why the signal might be wrong. They have the psychological strength to stand with the truth rather than their own desires. They don't overthink their potential profits. They overthink the conditions that would make their setup invalid. They spend less time clicking and more time sitting in trained patience, avoiding the mistakes others are making in real time. Part 3. The tactical retreat. This habit is perhaps the most controversial. At the peak of stress, they leave the screen. When the market is volatile, when the price is agonizingly close to a stop loss, or when a trade is deep in the red and every instinct is screaming for action, that is when the professional walks away. They aren't giving up. They are acknowledging biology. Under high stress, the amygdala triggers a fight-or-flight response, shunting blood away from the logical prefrontal cortex and into the muscles. This is great for outrunning a lion, but catastrophic for deciding whether to move a stop loss. The market intentionally creates scenarios that trigger this. The price hitting your stop, then bouncing, or a trade you closed in fear suddenly running to your target. When you stare at the screen in a state of reaction, you begin to protect your ego rather than your capital. You'll add to losers or close winners too early because it feels reasonable in the moment. Standing up is a tactical reset. When you return after 15 minutes, the chart hasn't changed, but your mind has. In trading, your psychological state is more important than your technique. Part 4. Selective messiness. If you entered the workspace of a truly successful trader, you might see a mess, unwashed cups, scattered papers, or a dusty screen. But if you opened their trading journal or looked at their statistics, you would find a cold, clinical clarity. This is selective organization. Mental energy is a finite resource. Research on decision fatigue shows that the quality of our choices declines with every decision we make throughout the day. Professionals don't waste that energy on trivialities. They may be messy where it doesn't affect the bottom line, like their desk or their clothes, so they can be incredibly disciplined where it matters. Their risk management rules, their journal entries, and their morning analysis. Traders who try to be perfect in everything often make the worst decisions by 3 p.m. because they've exhausted their willpower quota on a clean desk. The messy trader has saved their mental capacity for the moment the real opportunity appears. Messiness isn't the problem. The inability to prioritize is. Part 5. Controlled obsession. Successful traders often cycle through periods of intense obsession. They might spend weeks staying up until 3 a.m. to backtest a single concept or master a specific type of price action. They disappear from social life to go deep. Then, suddenly they stop. They've understood enough and they move on. This looks like inconsistency, but it is actually dopamine-driven learning. The brain thrives on the feeling of almost understanding something. In trading, the market doesn't teach on a schedule. It teaches in random, painful bursts. To learn, you must be able to go deep. However, the professional also knows when to let go. Adding more information past a certain threshold actually reduces decision quality by creating unnecessary complexity. Amateurs either stay on the surface or drown in analysis paralysis. Professionals move flexibly between these states. They dive deep when necessary and step back once they reach the point of diminishing returns. Part 6. External silence, internal noise. Have you noticed that the best traders rarely talk about their predictions in public? They don't argue on forums or declare where Bitcoin is going next. This isn't just humility. It's protection against consistency bias. Once you announce a prediction to others, you create a social commitment. Your brain then feels the need to protect that commitment to avoid the social pain of being wrong. If you tell everyone, "I'm long on gold," a part of your brain now needs gold to go up, causing you to ignore signs that you are wrong. Consistently profitable traders stay silent externally to keep their minds objective. However, when they are alone, they are noisy. They argue with themselves, write exhaustive journals, and question every assumption. Silence on the outside protects them from social bias. The dialogue on the inside helps them process the truth. They avoid market chatter not because they are arrogant, but because they know that every social interaction consumes the mental energy they need for the charts. Conclusion. The power of the pause. All 6 of these habits share a common thread. They are not about technical analysis or entry systems. They are psychological buffers designed to protect the quality of your decisions from your own human instincts. In the financial markets, human instinct is almost always wrong. When the market flies, instinct says buy, FOMO, which is the moment of highest risk. When it crashes, instinct says sell, fear, which is often the moment of opportunity. Professionals don't become robots. They simply build habits that create a pause between emotion and action. Self-talk is a pause. Overthinking the right things is a pause. Leaving the screen is a pause. Staying silent externally is a pause. Consistent profits aren't born from perfect strategies, but from the ability to not act when instinct is screaming and to act only when logic has finished its check. Look at your own strange habits. Have you tried to get rid of them because someone said they were weaknesses? If so, you might have been discarding your best tools of protection. If you have no such habits, ask yourself, between the moment you feel like doing something and the moment you do it, what stands in between? If the answer is nothing, then you found your problem. In this comprehensive video, we are going to pull back the curtain on our top 7 candlestick patterns, ranging from the most fundamental basics to highly sophisticated advanced formations. Our objective is not just to list these patterns, but to demonstrate exactly how you can utilize them in synergy with price action to identify high-probability trading opportunities. Ultimately, you should view this entire session as a complete candlestick trading masterclass. Before we dive into the heart of the lesson, I want to share a quick note. If you are interested in receiving our free professional training, simply click the link provided in the description to find out more. It is entirely free of charge. With that housekeeping out of the way, let's get straight into the details. The fundamental nature of candlesticks. To start, what exactly are candlesticks? At their core, candlesticks are a streamlined and visually intuitive method for analyzing the historical price data of any given asset. Each individual candlestick acts as a snapshot, representing the price movement of that asset over a specific defined period of time. For instance, if you are analyzing a daily chart, a single candle on that screen accounts for the total price action of one full day. When looking at the chart, you will generally observe 2 distinct types of candles, green candles and red candles. A green candle is generated whenever the closing price ends up higher than the initial opening price. This visual cue serves as a direct indicator that, during that time frame, the buyers were significantly stronger than the sellers. Conversely, a red candle is formed when the closing price finishes lower than the opening price, signaling that the sellers successfully overpowered the buyers. The anatomy of a candle. The reason the vast majority of professional traders prefer candlesticks over other chart types is that they provide a much deeper and more nuanced understanding of price fluctuations. A standard candlestick is composed of two primary parts: the wicks, often referred to as shadows, and the body. The tip at the very end of the upper wick reveals the absolute highest price reached during that specific time interval. In the same way, the bottom tip of the lower wick points to the absolute lowest price recorded during that period. When we examine the candle body, the interpretation shifts slightly depending on the color. For green candles, the lower boundary of the body represents the opening price, while the upper boundary marks the closing price. On a red candle, the arrangement is reversed. The upper boundary of the body is the opening price, and the lower boundary is the closing price. Core Concept 1: Big Body versus Small Body. Before we explore specific patterns, we must master a few underlying concepts. The first concept is the comparison between a big body and a small body. The physical size of a candle's body can tell you an incredible amount about the relative strength or weakness of market participants. Consider two different green candles. The first candle has a very large body with relatively tiny wicks. In this scenario, the price opened at the bottom, and while sellers initially tried to drive the price down, they were clearly weak. Buyers flooded in immediately, driving the price upward with massive momentum. Because they encountered almost no resistance from sellers, the price closed very near its high. This tells us buyers were in absolute control. On the second green candle, the narrative is quite different. The price opened and buyers did manage to push the price to a new high. However, at those peak levels, sellers stepped in with significant force and drove the price back down. The sellers were powerful enough to erase nearly all the gains, though the buyers managed to secure a close slightly above the open. In this case, buyers technically won, but the margin of power was negligible. As a general rule, when a candle's body is significantly larger than its wicks, it indicates that one side is firmly in control. When the body is small relative to the wicks, it suggests a fierce, undecided battle where neither side could gain the upper hand. Core Concept 2: The Meaning of Large Wicks. The second concept involves identifying large wicks. Whenever you spot a disproportionately long wick extending above or below the candle body, it provides a powerful clue regarding future price action. If you see a large wick protruding from the top of the body, it is a sign that sellers are aggressively defending those price levels. For the price to move any higher, buyers would need to exert an extraordinary amount of effort to break through that selling pressure. Similarly, a large wick appearing below the candle body demonstrates that buyers are stepping in heavily at those lower levels. If sellers wish to continue pushing the market down, they must first overcome the massive buy wall represented by that wick. Keeping these concepts of bodies and wicks in mind is essential as we move into the actual patterns. Pattern 1: The bullish pin bar. Moving into our basic patterns, the first is the bullish pin bar. This is a potent reversal signal that hints at a potential move to the upside. A classic bullish pin bar is identified by three specific elements: a small green body, a very large wick extending below that body, and either a tiny or non-existent wick above the body. The psychology here is fascinating. The price opens, and sellers immediately attempt to crash the market. They succeed in pushing prices quite low, but those discounted prices trigger a flood of buy orders. The buyers are so much stronger that they push the price all the way back up past the opening point. When you see this form after a prolonged downward move, it suggests sellers have exhausted their energy and buyers are taking over. To trade this, we typically look for other confirmations first, but a standard entry would be placing a buy order just above the pin bar's high with a stop loss below the low, targeting the next major resistance level. Pattern 2: The bearish pin bar. The bearish pin bar is the exact mirror image of the bullish version. It is characterized by a red candle with a small body, a massive wick reaching upward, and little to no wick on the bottom. This pattern indicates a potential reversal to the downside. The psychology is straightforward. The market opens, and buyers initially drive the price higher, feeling optimistic. However, sellers eventually enter the fray with such aggression that they push the price back down, crossing below the opening price and closing near the lows. This indicates that sellers have successfully seized the advantage. If other market factors align, a trader might place a sell order below the low of this pin bar, keeping a stop loss safely above the top of the wick. Pattern 3: The doji. The doji is perhaps the most unique pattern because it does not provide a specific directional bias on its own. Instead, it represents a state of total equilibrium. A doji is defined by having roughly equal wicks on both the top and bottom, combined with an extremely small body where the open and close are nearly identical. This formation shows that buyers and sellers were locked in a highly competitive struggle, but in the end, they were perfectly matched. While a single doji might just indicate a brief pause in a move, seeing several dojis in a row suggests a massive battle is taking place. Usually, once this period of indecision ends, the price will erupt in a violent breakout in one direction or the other. Pattern 4. The bullish engulfing bar. Now we move into intermediate territory with two candle patterns. The bullish engulfing bar occurs when a green candle completely swallows the red candle that came before it. Specifically, the green candle's high is higher than the previous high and its low is lower than the previous low. The story behind this is that sellers were initially in control during the red candle. When the next candle opened, they even tried to push the price lower, breaking the previous low. However, buyers suddenly intervened with overwhelming force, driving the price all the way back up and beyond the previous candle's high. This proves that buyers covered a much greater distance and are now the dominant force. For an entry, traders often buy as the price breaks the high of this green engulfing candle, placing a stop loss below its low. Pattern 5. The bearish engulfing bar. The bearish engulfing bar is a two-candle formation where a large red candle completely encompasses the preceding green candle. It starts with buyers appearing to be in control as they form a green candle. When the next candle opens, they attempt to push even higher, breaking the previous high. However, sellers recognize these highs as a prime opportunity to short, and their selling pressure is so intense that they drive the price down past the low of the previous candle. Since the sellers moved the price much further than the buyers did, they have effectively hijacked control of the market. A sell trade can be initiated below the low of this red candle, with a stop loss positioned above its high. Pattern 6. The Morning Star, Advanced. Entering our advanced section, we have the Morning Star, a three-candle bullish reversal pattern. It begins with a strong large-bodied red candle, showing sellers are in full control. The second candle is a small doji or pin bar, which indicates that buyers are starting to push back and sellers are losing their grip. The third candle is a large green candle that breaks above the high of the middle doji. The strength of this reversal is determined by the size of this third candle. If it is larger than the first red candle, the probability of a successful reversal is very high. This sequence shows a complete transition from seller dominance to a stalemate, and finally to buyer control. To trade this, you would place a buy order above the high of the green candle and a stop loss below the middle doji. Pattern 7. The Evening Star, Advanced. The Evening Star is the bearish equivalent of the Morning Star and also utilizes three candles. It begins with a strong green candle, buyer control, followed by a small doji, tug of war, and concludes with a large red candle, seller victory. This shows the clear progression of a trend exhausting itself and being overtaken by the opposite side. To enter a sell trade using this pattern, you would place your order below the low of the third red candle and keep your stop loss protected above the high of the doji. Mastering price action confluence. Understanding these 7 patterns is a great start, but to truly excel, you must learn to combine them with price action concepts like support, resistance, and trend lines. For example, imagine the price is in a downtrend but approaches a previously identified support level. As the price nears that level, you notice the candles getting smaller, a sign of fading momentum. If a Morning Star pattern then forms exactly on that support line, it provides a very high probability buy signal. Another example involves trend lines. If you have a solid descending trend line and the price approaches it, you wait for a signal. If a bearish engulfing candle forms right as the price touches that trend line, it confirms that the trend line is acting as strong resistance, offering a prime shorting opportunity. Final thoughts and next steps. Always remember that candlestick patterns should not be traded in a vacuum. On their own, they are just shapes. However, when you combine them with key levels and market structure, they become a powerful trading system. I hope you found this masterclass informative and that it helps you refine your trading strategy. If you did, please make sure to hit the like button and subscribe so you never miss our future sessions. Don't forget to visit our website for further free training. I will see you in the next video. The Power of 73%, the Art of Doing Nothing. There is a single statistic that fundamentally restructured my approach to the markets: 73%. That is the precise amount of time consistently profitable traders spend doing absolutely nothing. While struggling traders are clicking their mice with the frantic intensity of a video game, the winners, individuals like Ethan Clark, are sitting in silence. They are observing. They are waiting. Today you will learn why patience is far more than a virtuous trait. In the brutal environment of trading, it is the essential lifeline that keeps your capital from evaporating. Most retail participants chase every flickering shadow of red and green on their screens. However, veteran traders like Lucas Grant operate under a singular, immutable truth. The market rewards precision, not activity. The biological trap. Why our instincts fail. Consider this. In what other profession does deliberate inaction yield the highest financial returns? The core issue lies in our biology. Our brains were never designed for the nuances of financial speculation. For millennia, hesitation was a precursor to death. Rapid reaction was the survival mechanism that kept our ancestors alive. Yet in modern financial markets, that very instinct is exactly what incinerates accounts. Observe the stereotypical beginner. Their eyes are fused to every minor tick. Their hands are white-knuckled on the mouse, ready to pounce on the slightest volatility. They feel productive. They feel engaged. Yet, statistically, they are hemorrhaging capital faster than they can comprehend. Meanwhile, elite traders like Ethan lean back. They analyze market structure. They wait. Not for mere movement, but for meaningful, high-probability opportunity. The silent tax of impatience. Impatience functions as a silent regressive tax. In this industry, it is likely the most exorbitant fee you will ever pay. Every premature entry, every FOMO-driven click, every just this once violation of your protocol, these errors accumulate until they manifest as catastrophic long-term losses. Let's examine two traders in the exact same market. Trader A is impulsive. He enters 20 low-quality setups weekly, risking 1% per trade. He carries 20% exposure with almost zero expected return. Trader B is patient, following the Ethan-style methodology. He takes only 3 to 5 high-conviction setups. Despite having only 3% to 5% total exposure, his risk-adjusted performance is vastly superior. When you factor in spreads, slippage, commissions, and emotional fatigue, impatience becomes the most efficient way to achieve financial ruin. Active waiting. The sniper mentality. Patience is not to be confused with passivity. Professional patience is active waiting. It involves scanning multiple time frames, tracking liquidity pools, and preparing contingency scenarios. It is about updating journals, refining directional bias, and waiting for perfect alignment. Think of a sniper. There are hours of absolute stillness and endless scanning for a single perfect shot. Most traders operate like chaotic gunmen. They spray bullets indiscriminately, noisy, disorganized, and wasteful. As Warren Buffett famously observed, the stock market is a mechanism designed to transfer wealth from the impatient to the patient. He was not exaggerating. Selective traders build higher win rates. They endure shallower drawdowns. They protect their mental capital and avoid the burnout that comes from chasing meaningless market noise. The math of less is more. Imagine Trader A and Trader B both start with $50,000. Trader A is impulsive, taking 200 trades a year with 55% accuracy and a 1 to 1.2 risk-reward ratio. Trader B is patient, following the Lucas-style approach. He takes only 50 trades a year but maintains 65% accuracy and a 1 to 2 risk-reward ratio. Trader B takes 75% fewer trades, yet he doubles the performance of Trader A. He does this with significantly less stress and far less time chained to a desk. Here is a reality few admit. Trading platforms are engineered to make you click. Flashing prices, instant news alerts, and one-click execution buttons are all designed to trigger impulsive lizard brain behavior. This is why successful traders develop strategic boredom tolerance. This is the ability to treat silence as productive work time rather than wasted time. Strategic boredom and market phases. Most significant market expansions occur within a few specific volatility windows. Outside of these periods, price action is merely noise. Pros adhere to rigid criteria: technical confluence, key institutional levels, trend synchronization, volume validation, and a minimum 1 to 2 risk reward. If these conditions are absent, they do not participate. This isn't a missed opportunity. It is the proactive protection of capital. Psychologically, some of your most profitable days will be the ones where you execute 0 trades. Life teaches us that productivity equals output, but trading teaches the inverse. Success in this field often stems from the choice not to act. You must learn to celebrate the trades you didn't take, because those saved dollars constitute your actual long-term wealth. The 70-30 rule of markets spend roughly 70% of their time in consolidation and only 30% in the trending phases where true wealth is generated. Impatient traders exhaust their ammunition during that 70% sideways grind. Professionals wait for the 30%. They recognize accumulation and distribution patterns and wait for the breakout confirmation. They would rather miss the first 20% of a massive move than lose their fingers trying to catch a falling knife. Patience does more than just repair your equity curve. It transforms your character. You become more rational, more composed, and more long-term in your thinking. Trading discipline eventually manifests as life discipline. However, a word of caution. Many traders mistake fear for patience, training the muscle of stillness. Hesitating on a valid setup is not patience, it is fear. Waiting for a perfect setup that never arrives is not patience, it is perfectionism. Real patience is waiting for good enough. It is about consistency over perfection. Occasionally, the market offers gift setups, clear direction, minimal risk, and massive reward. But if you have been overtrading, you will be too mentally exhausted and financially drained to capitalize on them. Patience is a skill that is trained, not a wish that is granted. You build this muscle by holding winners longer, moving to higher time frames, and implementing mandatory cool-down periods after losses. Professionals understand that trading is a game of large numbers played over thousands of iterations. A single win or loss is statistically irrelevant. Only the consistency of the process matters. The ultimate edge in an automated world. They embrace a truth that most will never grasp. Not losing money is the same as making money. Every avoided loss is net profit. In a world increasingly dominated by high-frequency algorithms, humans often feel obsolete. But there is one thing no machine can replicate: the human capacity for patience. Algorithms can react in microseconds, but they cannot wait better than a disciplined human. Your stillness is your ultimate advantage. Your ability to remain tranquil while the herd panics is your specific path to success. In the final analysis, the market will always reward the trader who can master the art of standing still. Breakout strategies. The art of setting support and resistance lines and waiting for that one decisive moment when the price finally bursts through. When it happens, the move is often explosive. But how do you trade this strategy successfully? Is there a secret formula? The answer is yes, there are a few secrets, and I'm going to share them with you in this video. Let's not waste any time and get straight into it. Has this ever happened to you? You meticulously set your support and resistance lines and wait for a breakout. Once the price surges through resistance, you enter the trade with excitement, anticipating a massive jump. You grab your popcorn, sit back and watch the monitor, only to see the price suddenly reverse and dip. You're left staring at the screen in confusion as your portfolio tanks. I'm going to teach you a secret today so this never happens to you again. First, we must define a breakout. A breakout occurs when you have support and resistance levels established by multiple key rejections. The actual breakout happens when the price bursts through one of these levels. Notice what happens. When the price breaks through, it often begins to soar, making the breakout point a prime entry opportunity. But how do we find these setups? The answer lies in breakout patterns. You've likely seen these before. the wedge, the flag, the rectangle, the triangle, and the pennant. A common mistake traders make is looking for the exact price action shown in textbook images. In reality, the market rarely mimics these patterns perfectly. You shouldn't look for the exact image. Instead, look for the key support and resistance levels that define that pattern. Honestly, the specific name of the pattern doesn't matter much. The vital takeaway is that all these patterns share a common trait. The price consolidates between two key levels and eventually breaks out. Suppose we find a consolidation that looks like a rectangle, with multiple points of support and resistance. The more touches these lines have, the better. Most traders wait for a break in either direction. When they see a candle cross the resistance line, they jump in immediately. Often this turns out to be a false breakout, where the price reverses in the opposite direction, leading to significant losses. I'm going to show you how to prevent this and increase your odds of success. To do this, we must understand momentum candles. These usually appear as one large candle with a big body, or a sequence of three medium-sized candles moving in the same direction. These momentum candles are what we are looking for. For example, if we have a resistance level based on previous higher highs and a support level where price has reversed multiple times, we wait. If a candle forms and breaks the resistance, but only the tip of the wick crosses the line, we do not count it as momentum. To qualify, the majority of the candle's body must be across the resistance level. Alternatively, if a second green candle appears entirely outside the line, we could consider that momentum. If a red candle appears instead, we ignore the signal. By waiting, we avoid what would have been a false breakout. Let's look at another example. If a small candle breaks resistance, we wait for further confirmation. If the second candle is also small, we continue to wait. If a third green candle appears, it is an extremely bullish sign, and that is when we enter. Once you see this momentum, three things can happen. The price keeps climbing, it pulls back to the resistance level and bounces, or it falls back through for a false breakout. Should you wait for a pullback or enter immediately? I prefer a strategy that puts the odds in my favor regardless of the outcome. I enter at the close of the momentum candle and set my stop loss just below the resistance level. This way, if there is a pullback and a bounce, the price won't hit my stop loss and I stay in the trade. If it goes straight up, I'm already in. Because we waited for a momentum candle, the chance of a false breakout is very low. Now for the exit strategy. Breakouts often have massive upside, so a standard 1.5 risk-reward ratio might leave a lot of profit on the table. To maximize gains, I use a two-step take-profit system. First, set your stop loss below the resistance line and set your first take profit at a 1.5 ratio. Once the price hits that mark, sell exactly half of your position to guarantee profit. For the remaining half, move your stop loss up to your original take profit mark, break even. To determine the final exit, we use the chandelier stop indicator. Go to TradingView, add the chandelier stop indicator, and set the ATR multiplier to 2. This creates a simple exit plan. Stay in the trade until the indicator changes color. By selling half at the 1.5 mark and letting the rest run, you capture extra profit that you would have missed otherwise. You'll also notice many breakouts move straight up without a pullback, which is why entering early is beneficial. Let's review one more time. Find your key support and resistance levels. Wait for a momentum candle, either one giant body or 3 consecutive candles to break through. Enter the trade, place your stop loss below the resistance line and set your first target at 1.5. Sell half at the target, move your stop to the target price and use the chandelier stop to exit the rest when the trend shifts. I've just shared the secrets to significantly improving your breakout trading. All I ask in return is that you take 2 seconds to like this video. If you want a part 2 to make this even more profitable, check out my other video. Thanks for watching, and I'll see you next time. In this video, we are going to provide a comprehensive guide on how to master candlestick charts with speed and precision. Here's exactly what we will be covering today. As always, if you find this content valuable, please hit the like button. It directly supports our team in producing more high-quality educational videos on YouTube. The anatomy of a candlestick. To start, let's break down how to actually read a candlestick. Green candles are bullish, indicating that the price appreciated and moved upward during that specific time frame. Conversely, red candles are bearish, signaling that the price depreciated and moved lower. The rectangular center of the candle is known as the real body. The thin lines extending above and below are called wicks, shadows, or tails. For bullish green candles, the opening price is located at the bottom of the body, while the closing price is at the top. For bearish red candles, the opening price is at the top and the closing price is at the bottom. The tips of the wicks represent the extreme price action of that period. The top wick marks the highest price reached, and the bottom wick marks the lowest price recorded. Understanding momentum through body size. The size of a candlestick body is a vital indicator of market strength. A large body represents a significant gain in momentum, as the price traveled a great distance during that period. A small body indicates a loss of momentum, as the price movement was much more restricted. When a candle has an extremely small body, or no body at all, it is called a doji. This represents indecision between buyers and sellers. During this time, the price may have swung up and down significantly, but it eventually closed very near its opening price, showing that neither the bulls nor the bears gained any ground. Candlesticks are essential because they tell the story of market participants. The patterns they form reflect the real-time psychology of buyers and sellers, which is why traders use this price action to make informed decisions. Navigating the charts. Let's apply this to a real chart using Apple stock as our example. On the top left, you will see the time frame. Currently, it shows 1D, meaning the daily time frame. Every individual candle represents one full day of trading. If we switch to 1W, weekly, or 1H, hourly, each candle would represent 1 week or 1 hour, respectively. The horizontal bar at the bottom displays the date and time. By hovering your mouse over a candle, you will see dotted lines connecting it to a specific date, such as January 3rd. Moving one candle to the right brings you to January 4th. The vertical bar on the right shows the asset's price. For a green candle, placing your mouse at the bottom of the rectangle shows the opening price. For instance, $100 to $26.05. Placing it at the top shows the close, such as $129.61. This indicates the stock appreciated by $3.56, signaling bullish interest. The wicks will show you the intraday extremes, like a low of $124.90 and a high of $130.30. Analyzing trends and market direction. Conversely, for a red candle like the one on January 3rd, the opening price is at the top, $130.24, and the close is at the bottom, $125.13. This $5.11 depreciation represents bearish price action. If you wish to use the same professional charting platform seen here, visit my channel on description. When red candles outnumber green candles, the asset is in a downtrend, showing depreciation as sellers dominate. When green candles prevail, it is an uptrend, showing appreciation as buyers drive the price higher. Groups of same-colored candles indicate strong directional momentum. However, a mix of colors moving horizontally signifies indecision or consolidation in a choppy market. We want to hear from you. Tell us in the comments which topics we should cover next. Master price action. Access our premium technical analysis and start trading like a pro today on description. Identifying trend changes. An uptrend is defined by a series of runs and pullbacks, creating higher highs and higher lows. In this environment, traders generally look for long buy entries to align with the bullish momentum. However, trends eventually shift. There are three main types of trend reversals from up to down. Type 1, price forms a lower low. Type 2, price forms a lower low followed by a lower high pullback before breaking down further. Type 3, price forms a lower high first, signaling exhaustion before the reversal. A downtrend consists of lower highs and lower lows. Here the sellers are in control, and traders typically look for short sell opportunities. To spot a reversal back to an uptrend, look for higher highs or higher lows to form, signaling that the bulls are regaining control. In a sideways or ranging market, the price oscillates between the same highs and lows. In these scenarios, traders may look to trade both directions with confidence as price bounces between established boundaries. Spotting momentum, gain and loss. There are two primary ways to identify momentum gain. First, look for tight price movement. If price moves steadily in one direction without wide counterswings, one side is in absolute control. Second, look for candles that are growing in size. As each candle covers more distance than the last, it signals accelerating momentum. Conversely, momentum loss can be identified in three ways. Wide swings. When tight movement is replaced by volatile wide swings, it suggests the dominant side is losing control. Shrinking candles. If candles progressively get smaller, The distance traveled per period is decreasing, leading to a potential reversal. Color change. After a long string of same-colored candles, the appearance of an opposite color indicates that the trend has failed to produce a new extreme, signaling exhaustion. Take your trading further. We host a wealth of exclusive content there that will never be available on YouTube. Thank you for watching, and we will see you in the next episode. Get the ultimate trading blueprint. Join our community and gain access to high-probability trade signals. The paradigm shift. Redefining trading success. EAR is a transformative concept that may permanently alter how you quantify success in the financial markets. Most retail day traders execute over 150 trades every single month, yet they still struggle to maintain consistent profitability. In stark contrast, the traders who endure the longest, those whose accounts demonstrate quiet, compounding growth year after year, often execute fewer than 20 trades in that same time frame. What separates these two distinct groups isn't a disparity in intelligence, nor is it starting capital, sophisticated indicators, or premium charting software. It is something far more fundamental and, ironically, something the vast majority of traders never truly master: patience. Once you internalize the power of this psychological edge, your perspective on the market will be altered forever. The statistical reality of frequency. A landmark study conducted by the University of Chicago analyzed more than 66,000 trading accounts and unveiled a startling reality. When traders reduced their trading frequency by half, their overall returns surged by an average of 87%. Let that profound truth sink in for a moment. By doing less, these individuals earn significantly more. This isn't merely motivational rhetoric. This is empirical, statistical evidence that patience serves as a measurable and repeatable trading advantage. Despite this, the entire retail trading ecosystem is meticulously engineered to goad you into impatience. Flashy Discord alerts, rapid-fire notifications, and social media gurus showcasing their latest 10-second scalps are all strategically designed to trigger a specific neurological impulse. Act now. Trade now. Do not miss out. The industry profits from your frantic impatience, not your ultimate success. However, the traders who truly dominate the arena behave in a completely different manner. Their genuine edge doesn't lie in discovering more setups. It lies in the courage to ignore 95% of them. A tale of two destinies. Consider a story of two traders, inspired by real behavioral patterns found throughout market history. Imagine Lena. She begins her morning by meticulously reviewing her key levels, fundamental catalysts, and the broader macro context. She identifies a handful of high-probability zones, and then she waits. On some days, she doesn't place a single order. Over the course of a month, she executes an average of 18 trades while maintaining a robust 64% win rate. Her methodology mirrors legendary figures like Paul Tudor Jones, quiet, methodical, and waiting for asymmetric opportunities where the reward far outweighs the risk. Then, there is Mark. Mark is perpetually glued to his screens from the opening bell to the close. His mouse hand never ceases movement. Every minor stretch of momentum feels like the one. He trades simply to feel active, to convince himself he is working hard. He executes roughly 140 trades a month, but his win rate languishes at 41%. His style is reminiscent of the early, undisciplined years of Jesse Livermore, when emotional impulses led to devastating financial swings, before he eventually learned the necessity of discipline. The hidden cost of activity. At first glance, Mark appears more committed and hardworking. However, 6 months later, Lena's account has ascended by 34%, while Mark's account has plummeted by 18%. They occupied the same market and witnessed the same opportunities, yet they face two completely different destinies. The reason is painfully elementary. Lena only strikes when the statistical odds are heavily in her favor. Mark, conversely, trades out of boredom, noise, and a craving for adrenaline. The world's most iconic traders all exhibit the same pattern of behavior. Look at the legends. Warren Buffett has held core positions for decades. He famously stated, The stock market is a device for transferring money from the impatient to the patient. Richard Dennis, the architect of the turtle trading experiment, instructed his students to wait for extremely specific breakout conditions and disregard everything else. Paul Tudor Jones famously remarked, "The best traders are risk managers first and traders second." This implies they wait for the perfect shot rather than firing blindly into the dark. The neuroscience of the edge. Across every time horizon, whether long-term swing trading or intraday scalping, patience compounds into a massive competitive edge. When you decelerate, you naturally select cleaner setups. You successfully bypass emotional trades and significantly reduce cognitive fatigue. You remain calm enough to discern genuine momentum and preserve your precious capital for true opportunities. If you are executing over 150 trades a month, you are essentially claiming that the market provides high probability setups every single day. But look around and ask yourself, does that sound logical? Markets trend perhaps 20% of the time and chop through sideways noise the remaining 80%. Impatient traders cannot endure that silence, so they force their hand, trading boredom and noise. Patient traders do the exact opposite. They wait for those rare golden windows where the entire market structure aligns. Rewiring the trader's brain, neuroscience actually supports this disciplined approach. Repeated emotional losses physically damage the prefrontal cortex, the region of the brain responsible for rational risk calculation. Simultaneously, these losses overactivate the amygdala, which amplifies fear and impulsive reactions. In simpler terms, impulsive trading literally impairs your ability to think. Conversely, patient trading improves your brain's decision-making architecture. This is precisely why elite prop firms value patience above all other traits. They don't reward erratic big wins. They reward controlled, repeatable behavior. Patience eventually rewires your entire relationship with the market. Impatient traders view the market as a battle they must win. Patient traders view it as a complex system they must understand. When you stop trying to force outcomes, losses cease to feel personal. Missed moves no longer sting. The scoreboard of the professional. Your identity is no longer tethered to the daily fluctuations of your equity curve. You begin to recognize the rhythm of expansion versus contraction, accumulation versus distribution, and high quality versus low quality momentum. You learn exactly when to strike and when to disappear. Some months you might take 30 trades, some months you might take only 5. Both approaches can be correct. You do not need to trade constantly, you need to trade selectively. And with time, just like the greats, you will begin to see patterns that others are too frantic to notice. The less you react, the more you understand, and the more you understand, the more you grow. The traders who thrive over the long term all share one indispensable skill. They know exactly when not to trade. Their scoreboard isn't their daily P&L, it is their adherence to their process. A losing day executed with perfect discipline is still categorized as a win. A profitable day achieved by breaking rules is viewed as a dangerous warning sign. This mindset fosters emotional stability, a type of internal quiet that the market cannot disturb. The evidence is overwhelming. Fewer trades lead to better results. Patience leads to clearer decisions. Selectivity leads to a stronger edge. Your real competitive advantage will never come from the frequency of your trading. It will come from the quality of your waiting. This is the only strategy I have used that has consistently proven to be effective and profitable over the past 3 years. Its beauty lies in its simplicity. I only utilize a specific strict set of rules that I adhere to with absolute consistency. The reality is that this unwavering consistency, combined with these straightforward rules, has been the primary driver of my profitability using this method. Now, it is important to note that this strategy isn't exactly designed for absolute beginners. To use it successfully, you do need to possess a fundamental understanding of how the market operates. If you consider yourself an intermediate trader and have a grasp of the market, meaning you understand the basics of trading, such as candlesticks, specific patterns, support and resistance, and the general flow of momentum, then this strategy will prove to be incredibly effective for you. The definition of a good strategy. What truly defines a successful strategy? Is it merely the capacity to generate millions of dollars during your very first year of trading? Well, the answer is both yes and no. A high-quality strategy certainly can involve the ability to make substantial sums of money. For instance, I am currently in a live trade and I am up $1,400 on it right now. That is the level you can eventually reach, where you are making $1,000, $2,000, or even $3,000 in a single day. However, the core of the matter isn't just about the dollar amount you are earning. It is about how consistent and reliable the strategy remains over time. That is what makes this specific strategy so remarkable. Understanding market flow and trends. To truly maximize the effectiveness of this strategy, the very first thing you must master is the flow of the market. If I navigate to any time frame or any currency pair, you will always encounter the same types of structural setups. The first concept I want to cover here is the trend. In every market and on every chart, you will always observe a flow. You can look back at previous highs and mark out the general trend of those peaks. You will notice that every time you mark a point where a break occurs, the price consistently has a tendency to return to those specific areas. The exact same principle applies to the opposite direction. If we draw a trend line hitting 3 significant points, we see that every time one of these trends is broken, price likes to return and touch the zone between those points. By understanding this behavior, you can actually assume, given the right moves and momentum, exactly where the price is headed. We know that when price reaches a certain low, it will eventually aim back for a previous high, then return to a low, and so forth. This works for everything. We can zoom in and repeat the exact same process. We take our trend line, run it through the data, and mark the line where the breakout occurred. Price almost always likes to return to that break. Repeating this cycle over and over is one of the fundamental understandings required for this strategy. Applying the strategy and broker choice. Knowing that price fluctuates back and forth between these specific zones allows us to apply our trading strategy. I am going to demonstrate exactly how to execute this simple 4-step strategy right now. If you are currently looking for a reliable broker to use so you can start applying this strategy today, go ahead and click the link in the description below to join with me. They are a fantastic broker for active trading and, importantly, they are fully regulated. If you want a platform that is secure and regulated, click the link in the description, start trading today, earn your profits, and withdraw your money to gain the financial freedom you desire. Live example, the 15-minute to 1-minute transition. Let's look at a random point in time on the charts. We will start on the 15-minute time frame and mark out some key areas. Here we had a nice little trend that has since been broken. Because of that break, we can now look to trade the price back up to that original breakout line. To find our entry, we drop down to a lower time frame. Since we started on the 15-minute, we will jump down to the 1-minute chart. Note, sometimes we cannot jump back too far on the 1-minute due to data limits, so I will use replay mode to show you a specific scenario. We identify where the trends were and look specifically for the breaks. Once we have our area selected on the 15-minute, we highlight the breakout point. When we drop to the 1-minute chart, we are looking for trades that target that specific line. The core rules of entry. How do we actually find a trade back up to that line? It involves a simple set of rules that has proven to be very consistent over and over again. All we need to see is a break of a previous lower high. I mark out the lower high by using the MACD indicator. On the MACD, I find a peak and mark the highest corresponding spot on the price chart. Now all we are doing is waiting for a true break of that high so we can trade the price back up. A true break means we don't just want a wick. We need to see a candle close above the level, followed by another candle closing above that breakout candle. Once we have that confirmation, we look for our entry. In this example, we enter the trade, target the line we identified on the higher time frame, and set a simple 1-to-1 risk to reward ratio. Boom! Just like that, the price hits our take profit. That is the foundational basis of this strategy. The step-by-step process. To ensure you fully understand, I will break this down into a specific step-by-step process. Step 1. Higher time frame analysis. Start on a higher time frame like the 15-minute or the 1 hour. Do not start on the 1-minute chart. If you start on the 1-minute, you would have to drop to something like a 5-second time frame for entry, which most traders don't have access to. The 15-minute chart is the easiest and most effective place to start. Step 2. Identifying the trend break. Using replay mode as an example, you are looking for a clear trend. Once price breaks out of that trend, you mark the line from which the price broke out. This line is your target, your take profit. You are looking for price to break away, and then you are looking for a high probability opportunity to enter and bring the price back to that line. Step 3. Lower time frame execution. Jump down to the 1-minute chart. Now you are looking for a break of the previous structural high, the lower high. Mark out that high and wait for price to break above it. You must ensure it is a true break, where candles close convincingly above the level. Step 4. Setting the entry. As soon as you have that confirmation, you enter right on the break line. It is incredibly simple. You could enter a bit earlier or wait for a deeper pullback, but to get the best risk to reward and stay consistent, entering on the line is often the most effective method. Set your stop loss below the recent low and run the price up to your take profit target. If you learn to do this consistently, it becomes very easy to make money with this strategy. Additional examples and realities. I'll show you another example from scratch on a different pair, like EUR/GBP, to show you this isn't staged. We mark a trend on the 15-minute chart and wait for a break. In one scenario, we might miss an entry because the price doesn't pull back far enough to hit our limit order. This is the reality of trading. Sometimes you miss the trade because you are being disciplined with your entry on the line. However, if we look closer, we might realize our structural mark was slightly off. If we had marked the correct high-low, we would have been triggered into the trade. Let's try one more example to do it properly. On the 15-minute chart, we find a trend break. We wait for the price to move away, then jump to the 1-minute chart. We mark our structural point and wait for a break. Once we get that true break, we set our target down at the original breakout line and our stop loss above the recent peak. Price taps into our entry, and we can switch back to the 15-minute chart to see the trade play out. Boom! Price hits our take profit again. Conclusion. This strategy is incredibly consistent, effective, and profitable. It has worked for me for the past 3 years, and I believe it can work for you as well. It is arguably the most simple and effective intermediate strategy available. I hope it helps you achieve the financial freedom you are looking for through trading. I appreciate you watching the video. As always, please leave a like if you found this helpful. If you are ready to get started, start using this. The trading world is filled with a vast ocean of patterns. The bullish engulfing, the bearish engulfing, the hammer, the shooting star, the evening star, the harmonic, and the flag. Every one of these unique formations exists for a reason. While some of them might seem confusing or obscure to you right now, providing clarity is exactly why I created this video. I am going to review every single one of these patterns to the absolute letter, explaining their purpose and the underlying mechanics of why they form. By the end of this video, every line, color, and shape on your screen will make perfect sense. These patterns are far more than just random aesthetic designs on a chart. They represent actual tangible market movements that occur repeatedly because of the collective behavior of other traders. Once you understand them, you can truly capitalize on them. I won't just show you how to spot them. I'm going to teach you exactly how they function, so you can use them to your advantage every single time you trade. Before we dive into the deep end, however, there's one very important thing to understand. Out of all the patterns I am about to teach you, you do not need to use every single one of them in your daily routine. I am educating you on the full spectrum so you have a comprehensive knowledge base. But to be a successful trader, you really only need to master between 5 and 10 of them. As we go along, I will specifically point out the ones I rely on every single day to maintain my success, and distinguish them from the ones you might not necessarily need to use. I will still explain those secondary patterns and how they are utilized so you can have total peace of mind. This way, when you see them on a chart, you can identify them instantly rather than feeling lost, even if you know they aren't essential for your personal profitability. With that groundwork laid, let's begin. The anatomy of the candlestick. First and foremost, we must define what a candlestick pattern actually is. To grasp this, you have to realize that price charts are built from different types of visual data. You might see a simple line chart or a bar chart, but the most widely recognized and utilized version is the candlestick chart. Those red and blue, or black and white, boxes you see, which you can customize to any color you like, are the candlesticks. They are called candlesticks for a very literal reason. The little lines at the top and bottom of the central box resemble the wicks of a candle where you would place a flame. When this visual concept is applied to financial charts, it creates the landscape we see every day. You should keep in mind that the size of the candle is a direct reflection of market volatility. A larger candlestick indicates a bigger move, while a smaller one represents a minor fluctuation. Every single piece of data provided by a candle is an advantage for you. If a candlestick ends with a large body, it carries a specific meaning. If it has a tiny body, that signifies something entirely different. Even a candle with no body at all, just a line and a small cross-section, provides highly effective information. In essence, when you are reading candlesticks, every box and every line is telling a story, indicating whether the market is moving in favor of your trade or against it. You must ensure you are interpreting these signals correctly, and remember that while they appear on all time frames with the same look, their impact and weight can vary. Momentum, the long day and the short day. Let's look at our first fundamental example, the long day. This is exactly what it sounds like, a candlestick with an unusually long body. This elongated body identifies a market with a massive amount of momentum. It shows that for that specific period, the directional force was incredibly strong, suggesting that the momentum is likely to carry over into the next period. This serves as a vital indicator. If you are already in a trade, it tells you to keep holding. If you are looking to enter, it tells you to move with that force. While colors vary, we typically use green for buyers and red for sellers. A big green long day means buyers are dominating, while a big red one means sellers are in total control. In direct contrast to the long day is the short day. Again, the name is self-explanatory. When there isn't a significant body or large wicks, we call it a short day. This is the visual representation of a choppy or slow market, often referred to as consolidation. It means the market simply didn't move very far, which is an inevitable part of trading. Some days are fast, others are slow. Learning to identify a short day allows you to recognize market indecision. It signals that the market is currently unsure if it wants to continue its current trend or reverse, and it is likely gathering energy for its next major move. Rejection and reversals, belt holds and stars. Next we have the belt hold line. This is a simple long candlestick, green for bullish and red for bearish, that opens at its absolute high or low and closes near the opposite end of its range. It signifies a potential reversal, especially when it appears after a long trend. This is also known as a market rejection, often accompanied by a large wick. Think of it this way. On a real candle, the wick stays behind as the wax melts. In the market, the price may have traveled far, but it melted back, leaving a trail, the wick, that shows where the price was rejected. Moving on to morning stars and evening stars. The names are very intuitive. A morning star represents the start of a new day, meaning things are looking up. It is a 3-candle formation. 1 red candle, 1 small indecision candle, and 1 large bullish engulfing candle. This shows a complete reversal from a downward move to an upward one. This is personally one of my favorite patterns that I use every single day when I am looking to buy. The evening star formation is the exact opposite. It's like the sun going down on a trend. This reversal pattern indicates the market is headed for a move to the downside. Like its counterpart, it consists of 3 candles, a green candle, a small rejection candle, and then a bearish engulfing candle that forces the market lower. This is one of my favorite entry signals. Along with my core strategy, these 2 star patterns are some of the most powerful entry signals you could ask for. They are highly effective, especially when considered across various time frames. I highly recommend writing these down and starring them in your notes. The power of rejection, shooting stars and crows. Next is the shooting star. While it might not look exactly like a celestial object, if you use a little imagination, you can see it. This candle appears at the potential end of an uptrend and consists of a very small body with a long upper wick. This tells us the market has no power to continue climbing and is rejecting higher prices. It indicates that buyers have stopped pushing and sellers are now stronger. This is another of my top-tier favorite entry signals because it provides clear confirmation that a reversal is imminent. We also have the 2 crows pattern. This is a bearish reversal pattern that occurs within an uptrend. It involves a long green candle followed by a similar red candle that opens within the body of the previous one but closes much lower. This pattern signals a distinct shift in momentum from the buyers to the sellers. Inside and outside patterns. Next we have the 3 inside up and down patterns, which are very simple yet highly effective. 3 inside up is a bullish reversal that starts with a large red candle, followed by a small green candle contained within the previous body, and a third candle that closes above the first candle's high. Conversely, 3 inside down is the bearish version. It starts with a large green candle, follows with a small red inside candle, and ends with a third candle closing below the first candle's low. The 3 outside up and down patterns are essentially the inverse. 3 outside up is a bullish pattern that begins with a bullish engulfing pair, followed by a third candle that closes even higher. 3 outside down is a bearish reversal that starts with a bearish engulfing pair and is confirmed by a third candle closing lower. Following these, we have 3 stars in the south, a bullish reversal consisting of 3 small-bodied red candles, each closing lower than the last. This suggests the bearish trend is gradually losing its strength. Then there are the 3 advancing white soldiers, 3 consecutive long green candles, each opening within the previous candle's body and closing higher. This is a very strong signal that a bullish trend is going to continue aggressively. The king of patterns, head and shoulders. Now we are moving into reversal patterns, and the next one I'm going to explain is by far my favorite and most effective. If I were to rank the top 3 patterns in my strategy, this would be number 1. I use this every single day, and it is extremely effective. The famous head and shoulders and its counterpart, the inverted head and shoulders. A head and shoulders pattern forms at the peak of a trend. It isn't officially confirmed until it breaks and retests the neckline. It consists of 3 peaks: the left shoulder, the first rejection, the head, the highest peak created by a final burst of momentum, and the right shoulder, a third peak that fails to break above the head. Once the price breaks below the neckline connecting these points, the reversal is confirmed. This is one of the most successful patterns I use, and I often try to only take trades that present this clear visual structure. The inverted head and shoulders is simply the same concept flipped upside down at the bottom of a downtrend. It consists of 3 troughs: the left shoulder, a deeper trough for the head, and a final right shoulder that fails to go lower than the head. When the price breaks and retests the neckline to the upside, it confirms that the market is no longer bearish and has turned bullish. These patterns happen more often than you might expect. My biggest tip is, the cleaner the visual, the better. Don't try to force a head and shoulders if it isn't clearly there. Double and triple tops / bottoms. My second favorite reversal pattern is the double top and double bottom. While highly effective, I'd rate it a 5 or 6 out of 10 in effectiveness compared to the head and shoulders 8 out of 10. However, they are much easier to spot. A double top occurs when the market hits a resistance point, rejects, returns to that same point, and rejects again. It looks like 2 equal peaks or cones. The ideal entry is the retest of the neckline. These happen more frequently than head and shoulders because they are less complex, but that frequency also means you need to be a bit more careful with them. The double bottom is the same thing, just reversed at the bottom of a trend to signal an upward reversal. Then we have the triple top and triple bottom. As you might guess, it's a double top or bottom with an extra rejection point. This is even better because it provides an additional layer of confirmation that the price is struggling to break a level. Be selective though. If the middle peak is higher than the other 2, you're actually looking at a head and shoulders. A triple bottom at the low of a move is a very strong signal, and the most effective trade is taken at the retest of the neckline. These 3 patterns, head and shoulders, double tops, stauncher bottoms, and triple tops bottoms, are the ones I recommend focusing on. It took me 4 years to master them, but the sooner you do, the better your results will be. The hammer and hanging man. Next we have the hammer and the inverted hammer. The hammer is a bullish reversal candle at the bottom of a downtrend, featuring a small body and a long lower wick. It looks like a tool you could use to hit something. The inverted hammer is also a bullish reversal at the bottom of a trend, but with a long upper wick instead. We also have the hanging man and the shooting star. The hanging man is a bearish reversal pattern that appears at the top of an uptrend. It looks exactly like a hammer, but because of where it appears, at the top, its meaning is different. The shooting star, as mentioned before, is the bearish rejection at the peak of an uptrend with a long upper wick. Engulfing candles. The ultimate confirmation. Now we come to what I consider my top 2 or 3 entry signals, the bullish and bearish engulfing candlesticks. If morning stars are my number 1, engulfing candles are my number 2. The concept is simple. To engulf means to swallow up or be bigger than the previous thing. A bullish engulfing candle is a green candle that is larger than at least the last 2 red candles combined. This can happen at support or as a continuation signal. A bearish engulfing candle is a red candle that eats the previous 2 green candles. These are very similar to morning and evening stars. It doesn't matter much which one you call it. Both make your trade better and your confidence higher. I personally will not take a trade unless I see one of these engulfing formations or a star formation. They are the cornerstone of my set and forget strategy. Harami, piercing lines and tweezers. Next is the Harami candlestick. A bullish harami is a small green candle completely contained within the body of a large previous red candle, suggesting a reversal. The bearish harami is a small red candle inside a large green one. Then we have the piercing line and dark cloud cover. A piercing line is a bullish reversal where a long green candle opens lower but closes above the midpoint of the previous red candle's body. The dark cloud cover is the bearish opposite, where a red candle opens higher but closes below the midpoint of the previous green candle. Finally, in this category, we have tweezer tops and bottoms. I use these occasionally. A tweezer top consists of two or more candles with nearly identical highs, suggesting an uptrend is ending. A tweezer bottom has identical lows, suggesting a downtrend is finishing. Continuation patterns, flags and pennants. Now we move into continuation patterns. Many of these involve trend lines. I should be honest. I am generally against trend lines because I find them too subjective. If everyone sees a line differently, it's hard to call it a reliable system. I prefer systems that are objective, where everyone sees the same thing. However, I want you to be aware of these. The bullish flag forms during a strong uptrend and looks like a small downward sloping rectangle, the flag, on a steep rise, the pole. You expect a breakout to continue the trend. The bearish flag is the inverse, occurring during a sharp decline. Then we have pennants, which look like small symmetrical triangles. A bullish pennant suggests a strong move up will continue, while a bearish pennant suggests the downward momentum will persist. Rectangles and triangles. Rectangles are actually my favorite continuation pattern, often called consolidation breakouts. A bullish rectangle is formed by two parallel horizontal lines acting as support and resistance. It's essentially a break and retest strategy once the price moves out of the box. Bearish rectangles work the same way, but break to the downside. I love these because they are objective. It's just a box. It's much clearer than a triangle. Speaking of triangles, we have the ascending triangle, flat top, rising bottom, which usually breaks upward, and the descending triangle, flat bottom, declining top, which usually breaks downward. A symmetrical triangle has both lines converging and can break in either direction, usually following the prevailing trend. Wedges and necklines. The famous rising and falling wedges are next. I used these early in my career but didn't find much success with them. A rising wedge is a bearish pattern where the lines converge while moving upward, suggesting weakening momentum. A falling wedge is a bullish pattern where lines converge while moving downward, suggesting a bearish trend is losing steam. We also have the on-neck, in-neck, and thrusting lines. These are all bearish two-candle continuation patterns in a downtrend. The on-neck closes near the previous low, the in-neck closes slightly inside the previous body, and the thrusting line closes more than halfway into the previous body. All three suggest that the sellers are still in control and the trend will likely continue downward. Indecision. The dojis. Next, we have the neutral or undecisive candles known as dojis. We touched on these earlier, and they are extremely effective when combined with other patterns like engulfing or star formations. However, on their own, they represent a lack of momentum. A standard doji has a tiny or non-existent body, showing a perfect balance between buyers and sellers. When you see these on high time frames, be careful. Indecisive markets can slow down your trade or keep you out of one because there isn't enough movement. I've seen these patterns last for weeks, where the market just moves up and down slightly but goes nowhere. This is a signal to step back and wait for momentum to return. The long-legged doji is the same but with much longer wicks, suggesting an even greater struggle. These can be dangerous because they often precede a violent breakout. Think of a surfer. You don't go out when there are no waves. If you enter a market with no volume, you're just waiting for a shark, a stop-loss hit, to find you. Stay away from these unless you're using them specifically for a reversal confirmation. Finally, we have the dragonfly doji, looks like a T, signaling a bullish reversal, and the gravestone doji, the inverse, signaling a bearish reversal. There's also the spinning top, which is very similar to a standard doji and represents the same indecision. Don't let people sell you different strategies based on these. At the end of the day, they all mean the same thing. The market doesn't know what it's doing yet. You need a strategy behind these candles. You cannot trade them alone. The powerhouse, the Marubozu. We will conclude with one of my favorite continuation candles, the Marubozu. This is a very powerful candle that you rarely see on higher time frames because it represents extreme strength. A Marubozu consists of one big block with no wicks at all. This means from the second the market opened, it moved in one direction and stayed there until it closed. There was no fluctuation and no pullback from the opposing side. Whether it is a bullish Marubozu or a bearish Marubozu, it is a key indicator to hold your trade. There is a fascinating phenomenon that occurs when you observe traders who consistently extract money from the markets. These are not the individuals who got lucky once, nor those who struck gold only to lose it all. These are the practitioners who month after month and year after year steadily generate profit. When you study them closely, you realize that their behavior contradicts almost everything you once believed about what a successful trader looks like. They aren't exhilarated when they win. They don't rush into trades when the market is soaring. There are days when they sit before their screens for hours and take no action at all. Sometimes they talk to themselves as if debating an invisible opponent. There are moments when they eye a clear opportunity, shake their heads, and simply walk away. To an outsider, they seem strange, indecisive, or prone to missing out. But that strangeness is exactly why their accounts flourish while others bleed towards zero. This video isn't a list of tips or a technical masterclass. It is a deep dive into the authentic psychology of consistently profitable traders, into habits that look peculiar from the outside but serve as the foundation for every correct decision they make. As you listen, you may realize you have done some of these things without knowing why, or perhaps you tried to stop doing them because others labeled them as weaknesses. Don't rush to the next video. Stay here. Part 1. The Internal Dialogue. Have you ever seen a trader whispering to their screen? If the price retraces here, I'm in. If not, I sit out. My stop loss goes here because... and if it breaks this level, the thesis is dead. Professional traders do this daily. It isn't because they are unstable. It's because they've grasped something most never will. The market does not care about your feelings. It only reacts to actions. The problem for most isn't a lack of technical skill. It's the dark gap between seeing a signal and clicking the button. That gap is where emotions slip in and sabotage everything. In psychology, this self-talk is known as verbal reasoning. By converting vague feelings into specific language, the brain